Welcome to today's video, where we'll be diving into one of the most critical concepts in finance, cost of capital. If you're a business owner, student, or finance enthusiast, this topic is essential for making informed investment decisions. By the end of this video, you'll know how to compute the cost of equity, preference shares, and debt, and understand the factors that influence cost of capital. Let's start with the basics. What exactly is the cost of capital? Simply put, it's the required return a company needs to earn in order to justify the cost of financing. It's the benchmark for deciding whether a project or investment is worthwhile. Understanding your cost of capital helps you gauge the minimum acceptable return on investment. This concept is key for long-term growth. Now, let's break down the cost of equity, a crucial concept in finance that helps determine the return that shareholders expect for their investment in a company. The return that shareholders expect is essentially their compensation for the risk they take by investing in the company. The most common way to calculate this is through the Capital Asset Pricing Model, or CAPM. Here's the formula that is widely used in the financial industry. Cost of equity, KE, equals risk-free rate plus beta times market return minus risk-free rate. This formula helps in quantifying the expected return. In this formula, the risk-free rate represents government bonds, which are considered safe investments with minimal risk. The beta measures the stock's volatility relative to the market, indicating how much the stock price might fluctuate. And the market return is the expected return of the stock market, reflecting the average return investors anticipate. Let's take an example. If the risk-free rate is 6%, which is typical for government bonds, beta is 1.2, indicating the stock is 20% more volatile than the market, and market return is 12%, which is a common estimate for long-term market returns. Then the cost of equity would be around 13.2%. This means shareholders would expect a 13.2% return for their investment in the company. Next, let's compute the cost of preference shares and cost of debt. These calculations are crucial for understanding a company's financial health and making informed investment decisions. These are easier to calculate than equity, which often involves more complex variables and market conditions. For preference shares, the formula is straightforward and easy to remember. Cost of preference shares, KP, equals dividend, market price of preference share. This formula helps investors determine the return they can expect from their investment in preference shares. For instance, if a company pays 8 rupees in dividends and the market price of the share is 100 rupees, then the cost of preference shares is 8%. This means for every 100 rupees invested, the investor earns 8 rupees annually. Now, for cost of debt, the calculation considers the interest expense and tax advantage. Here's the formula, which is slightly more complex but still manageable. Cost of debt, KD, equals interest expense, X, 1, tax rate. This formula accounts for the tax shield provided by interest expenses, making debt a cheaper source of finance. Let's say the interest expense is 10% and the company's tax rate is 30%. By applying the formula, we can determine the effective cost of debt. The after-tax cost of debt comes out to 7%. This means the company effectively pays 7% on its debt after accounting for tax savings, making it a cost-effective financing option. Several factors affect a company's cost of capital, which is crucial for financial planning and decision-making. Let's quickly review some of the key ones that play a significant role in determining this cost. Interest rates. Higher rates increase the cost of debt, making borrowing more expensive for companies. Business risk. Riskier companies have a higher cost of equity because investors demand a premium for taking on additional risk. Tax rates. Lower tax rates reduce the cost of debt thanks to the tax shield, which allows companies to deduct interest expenses. Market conditions. In a booming market, equity might be cheaper than debt, as investors are more willing to invest in stocks. For example, during periods of high inflation, interest rates rise, driving up the cost of debt for companies, making it more expensive to finance projects. Similarly, startups or companies in volatile industries often face a higher cost of equity due to increased risk, as investors seek higher returns for their investments. Let's look at two real-world examples. Tata Motors, a large established company, has a lower cost of capital because of its strong credit rating and predictable earnings. On the other hand, a startup like Ola, which operates in the highly competitive ride-sharing market, faces a higher cost of equity due to business risks and market volatility. These examples show how industry, market conditions, and risk profiles affect a company's cost of capital. To sum up, understanding your cost of capital is essential for making strategic decisions in business. Whether you're a startup or an established company, knowing how to compute the cost of equity, debt, and preference shares will give you a clearer picture of your financing needs. The key is to balance the risks and costs for sustainable growth. Thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe for more financial insights. Let us know in the comments if you'd like us to dive deeper into other financial topics.